Now we will discuss on buyback of shares and securities. Buyback is the process by which company buyback its own shares from existing shareholders, usually at a price higher than the market price. When the company buy back the shares, the number of shares outstanding in the market reduces. It is the option available to the shareholder to exit from the company. It is governed by Section 68 of the Companies Act 2013. Reasons for buyback. Why company goes for buyback? See, ideally, when company has ideal cash, then to use ideal cash and to improve earning per share, and another reason is to give confidence to the shareholders at the time of a falling price. Other reason is to increase promoters' shareholding to reduce the chances of takeover. Other reason is to improve return on capital, return on net worth. Other reason is to return surplus cash to the shareholders. These are the reasons for buyback. What are the modes of buyback? See, from the existing shareholders are the specified holders on a proportionate basis through the tender offer in a listed companies, from the open market through book building process. Further, under Regulation 4.1 of SEBI, Buyback of Securities Regulation 2018, a company shall not buy back its shares or other specified securities from the open market if the buyback is 15% or more of its paid-up capital and free reserves. So, this is a upper limit is given 15%. This is through open offer in a listed company. And other mode is from odd lot holders. See, what is this odd lot holders? It refers to shareholders who own a small number of shares that are less than the standard trading unit called a lot size set by the stock exchange. See, in the stock market, shares are typically traded in a round lots. Example, 100 shares per lot. So if an investor holds shares in a quantity that is less than round, say, round lot, example like 5 shares, 17 shares, 53 shares. So they are considered odd lot holders. So these shareholders may face difficulties in selling their shares in the open market because most trades happen in the round lots. So buyback from odd lot holders, then the companies sometimes conduct buybacks specially for odd lot holders to provide them with the liquidity, as the selling odd lot can be challenging due to low demand. Source of buyback. So a company can purchase its own shares and other specified securities out of its free reserve, or the securities premium account, or the proceeds of issue of any shares, or other specified securities. So these are the sources for buyback: free reserves, securities premium account, or the proceeds of the issue of any shares or other specified securities. However, buyback of any kind of shares or other specified securities cannot be made out of the proceeds of the earlier issue of same kind of shares or some kind of other specified securities. So buyback of any kind of shares or other specified securities shall not be made out of the proceeds of the earlier issue of same kind of shares or same kind of other specified securities. Conditions of buyback. Section 68 of the Companies Act. The conditions for buyback of shares are: articles must authorize, otherwise amend the articles by passing special resolution in a general meeting. Second one, for buyback, we need to pass a special resolution in a general meeting. But if the buyback is up to 10%, then resolution at board meeting is sufficient. Maximum number of shares that can be bought back in a financial year is 25% of its paid up capital. Maximum amount of shares that can be bought back in a financial year is 25% of paid up share capital and free reserves, where the paid up share capital includes equity share capital and preference share capital, and free reserves include securities premium. So here the difference is, for buyback we need to pass a resolution in a general meeting if it is about 10% and up to 25%. But if it is up to 10%, then board resolution is sufficient. Maximum number of shares that can be bought back in a financial year is 25% of its paid up share capital. Maximum amount of shares that can be bought back in a financial year is 25% of paid up share capital and free reserves. Post buyback debt equity ratio shall not exceed 2:1. Only fully paid up shares can be bought back in a financial year. Company must declare its insolvency in Form SH9 to Register of Companies, signed by at least 2 directors, out of which one must be a managing director, if any. Notice of the meeting for which the special resolution is proposed to be passed shall be accompanied by explanatory statement stating a full and complete disclosure of all the material facts. Explanatory statement shall contain full, complete disclosure of all the material facts. And why the buyback, the necessity of the buyback, the class of shares intended to be bought back, the details of amount invested under the buyback, the details of the time limit for completion of buyback. These all shall be mentioned in the explanatory statement. The company must maintain a register of buyback in Form SH10 and submit a return of buyback in Form SH11 annexed with the compliance certificate in Form SH15, signed by 2 directors, out of which one must be managing director, if any. A company should extinguish and physically destroy shares which are bought back within 7 days of completion of buyback. Observe 6 months cooling period. That is, no fresh issue of shares is allowed up to 6 months. No offer of buyback should be made by a company within a period of 1 year from the date of the closure of the preceding offer of buyback. The buyback should be completed within a period of 1 year from the date of passing of special resolution or board resolution, as the case may be. As the case may be means 10% or 25% limits. Then, what is Capital Redemption Reserve Account, CRR? Section 69 of the Companies Act, where a company bought back shares out of free reserves or out of the securities premium account, then an amount equal to the nominal value of the shares need to be transferred to the Capital Redemption Reserve Account. Such transfer detail to be disclosed in the balance sheet. The Capital Redemption Reserve Account may be utilized for paying unissued shares of the company to the members as fully paid bonus shares. So the restriction on buyback, Section 70, according to Section 70 of the Companies Act 2013, a company should not buy back its securities or other specified securities, either directly or indirectly, through any subsidiary, including its own subsidiaries, or through investment or group of investment companies, or when company has defaulted in repayment of deposits or interest payable thereon, or in redemption of debentures, or in preference shares, or repayment of any term loan. So these are all restrictions. The prohibition is lifted if the default has been remedied and a period of 3 years has elapsed after such default ceased to subsist. So this prohibition is lifted if the default has been remedied and the period of 3 years has been elapsed. And another restriction, when the company has defaulted in filing of annual return, declaration of dividend, and financial statement. So these are the restrictions on a buyback under Section 70 of Companies Act 2013. So now the conclusion is the Indian companies announced buyback in response to undervaluation position of their stocks in the capital markets. And they are well supported by availability of sufficient cash balance available for the same. Thus, on one hand, the premium offered in terms of buyback price announced offers an exit opportunity for shareholders, and on the other hand, it offers an opportunity for the company to use its liquidity position to extinguish its shares and issue them again in future. It prevents takeovers and mergers, that preventing monopolization and aiding the survival of consumers' sovereignty. Buyback can help in flattening share price. So price earning ratio and earning per share will be increased. So this is all what about the buyback. Thank you.